This is FRM Part 2, Book 4, Liquidity and Treasury Risk Measurement and Management, and the chapter on Managing Nondeposit Liabilities. Now, at first glance, you might automatically be tempted to think, oh, this is a chapter on capital structure. We're going to issue some debt and we're going to issue some equity. But that, of course, is not part of this chapter. We're still focused on the top right portion of the balance sheet, although we will leak a little bit down into some potential long-term debt liabilities. But the focus continues to be top right portion of the balance sheet. This is another chapter written by Rose and Hudgens out of their textbook, Bank Management and Financial Services. And as such, it's pretty well written. And I know I've mentioned this to you before, but it bears repeating. There are some excellent end of chapter questions that are included at the end of every one of their chapters. Now, there's a big heading up there, and I think they actually underline it. You know, these are not FRM questions, but nevertheless, they're probably good sources of the material inside of the chapter. And of course, they're a function of the learning objectives. We're up to 4 in this one. Differentiate the various sources of non-deposit liabilities. We'll take care of that with one introductory slide, and then we'll look at each one of those as we go through. We'll go ahead and calculate the available funds gap. We'll talk about some factors, and then we'll calculate kind of a weighted average interest rate towards the end of the slide deck. All right, let's take a deep breath and just go back to what we talked about in the previous couple of recordings. What do we know? We know that banks accept deposits and make loans. And in an ideal world, those deposits would be the entire source of capital for the funding of our long-term assets like mortgage loans and personal loans and car loans, right? But of course, that's not going to be sufficient enough to fund all of those assets. So we need to move kind of down the balance sheet. We don't want to go down all the way to equity, but we want to move down that side. So look at those couple of block points on the left. First priority is to make loans to all those customers from whom the bank expects to receive positive net earnings, right? Of course, that makes perfect sense. You know, we accept deposits and then we make loans, and we're going to earn the spread on the difference between those rates plus some fees involved in there. And so notice on the right-hand side, the circle point, most banks use deposits to fund these loans. However, there's a need for alternative funding sources because that deposit volume is probably not completely adequate, and sometimes it's inadequate. So those extra kind of alternative or extra funding sources are called non-deposit liabilities. Several types, and we'll talk about these, but of course, banks generally seek out the lowest cost source of borrowed funds available. Let me go back to a corporate finance lecture. You know, what's the goal of the business? Maximize shareholder wealth. How do we do that? We find projects that have lots and lots of cash flows, but we also borrow from those groups of investors that are going to charge us the lowest interest rate. So that arrow point down there at the bottom is consistent with everything that we've ever talked about with the goals of a business. So here's a quick illustration of all of these sources, and we've talked about a bunch of these in the past. Borrowings from the Fed, federal funds market, repurchase agreements, Eurocurrency deposits, CDs, commercial paper, non-deposit long-term, and then advances from Federal Home Loan Bank. Those are what we call non-deposit liabilities. And so let's go ahead and go through some of these in just a little bit more detail. All right, the federal funds market. You know, this name is a little bit misleading. Whenever I ask students, especially undergraduate students, tell me what the federal funds market is, they always say, oh yeah, that's when you borrow from the Fed. And of course, that's not the correct answer. This is mostly daily. It doesn't have to be daily, but it's mostly daily. Borrowings between and among Federal Reserve banks. Now, it's called the Fed funds market because all the way back in the old days, you know, thousands of years ago, let's say 1933, during the creation of their current financial system here in the United States, the way the federal funds market worked is that these Fed banks had deposits at the Fed, and then the Fed kind of did their own little wire transferring, whatever that meant back in 1933, between and among banks. And so it went through the Fed, and that's why it was called the Fed funds market. But now the banks don't have to, even though they hold deposits at the Fed, in order to operate in the federal funds market, they don't have to actually go to the Fed. They can do it between and among themselves. So that's the way the Fed funds market works today. Look at some of those arrows. Yeah, usually return within 24 hours. Can be used for loans to institutions. This is all as part of that correspondent banking. But remember, the biggest motivation for this Fed funds market is for banks who've had really, really good days. If you're a bank and you've accepted $10 in deposits, but you've made $100 in loans, that's a really good day because you've increased your asset base, right? But then you need to have reserves because of all the legal and regulatory requirements. So you go into the federal funds market. Let's see, type of these loans, overnight loans. These things are by far the most common. Normally they're unsecured. So, if you have this big Gibraltar bank that I talk about, that's probably a pretty solid bank. And so that doesn't have to be secured. But if I'm just Jim's bank and, I have one mortgage and 3 people depositing, well, then I might not have access to the federal funds market. But you can have contracts that extend to, a couple of days or even a couple of months. And a lot of banks do this automatically each day, continuing contracts. We have talked at length about repurchase agreements, so I'll just quickly remind you about this slide. What does the bank have over on its left-hand side of the balance sheet? It probably has some kind of low-risk securities. How about a no-risk Treasury bill? It's just sitting there, and so instead of going to the Fed funds market, it can just sell that Treasury bill, right? Receive cash today, and then agree to repurchase it tomorrow. And so it's kind of a self-securing loan. Remember that the interest paid and the interest earned, depending on which side of the repurchase agreement you're on, whether it's a repurchase or a reverse repo, it's just the difference between those two prices. I was fascinated to read, what is that, the fifth comment down there, less popular and more complex than Fed funds. Clearly it's more complex, but I'm guessing that you guys look at the repo market these days, and sometimes it's massive, sometimes it's not. Fed funds is easy, right? Repurchase agreements are a little bit more complex and a little bit more complicated. Now, of course, the Fed was originally designed to be the lender of last resort, which means that if financial institutions are unable to secure financing through the Fed Reserve banking system, and think about what that means. Remember, now these bankers, they know each other, right? So if I'm Jim and I'm a big bank, and I go over to my friend Becky's bank, and Becky and I, we've known each other for 100 years, went to the same college, our kids go to school together. And I say, hey, I need a bunch of money overnight. And she says, oh, no, you're too risky. I don't trust you. So she denies me that overnight loan. Then I have to go to the Fed. That's why it's called the lender of last resort. And the Fed knows that I've been denied by all my friends. So that's probably a signal to the Fed that I'm not maybe meeting all of the financial ratios that I probably should be. Several types of loans. These are obvious notions: primary and secondary and seasonal credits. Now, we can also get advances from the Federal Home Loan banks. Typically, we do this by using mortgages as collateral. And what this does is it not only adds liquidity to the mortgage market, but it allows us as a financial institution to tap in to that liquidity in the mortgage market. And once again, a lot of these are overnight, but they can extend to lots of years, even past 20 years. We spent a good time talking about CDs in the previous recording. And so we know that these are interest-bearing receipts. You go ahead and make a deposit in there and you say, hey, this is for a specified time period, and I'm hoping to get some kind of an interest rate. Now, the interesting things about a negotiable CD is that they are negotiable, right? That means you can sit down with the financial institution and negotiate the terms. I could come in and say, I have $1 billion. Now, I'm not going to do that as Jim, right? If I'm just Jim and I only have $1,000, I'm probably going to just have to use a regular old certificate of deposit. But if I have $1 billion and I'm Jim's massive financial institution, I can go in and sit down and say, I want this for 33 days and I want it at this interest rate, take it or leave it. And then I can just kind of figure out exactly what the details are of that contract. And so there are some types of negotiable CDs. The interesting thing mathematically in determining the interest rate on these negotiable CDs is that the rate is determined on a 360-day year. And I know I've said this to you before, but just remember that back in the old days when we didn't have computers, it was a lot easier to divide by 360 than by 365. And that's why that's just really the case. So let's look at an example here. 10% annual interest rate. So that's the stated rate. 950,000, 4 months. So calculate the amount the investor will receive in 4 months. So there's the good old equation. Just think about this. You take the principal, right, the 950, and you multiply it by the annual interest, 10%. But of course, that's an annual interest rate. So then we need to chop this up into the 4-month time period. So that's why we do the 120 over the 360. So we get 981,666. And so essentially what you do is this investor is buying at 950 and then selling for 981. And then if you put that in your calculator and do some, kind of quick time value of money math, that APR probably turns out to be, 10.1% or something like that. We can also have Eurocurrency deposits, and this is exactly what the name probably doesn't suggest. It suggests that you have to have some kind of a currency that is tied to Europe, but that really isn't the whole case. I mean, seriously, we have banks, financial institutions throughout the world that will accept deposits in any kind of a currency because, after all, this is what banks do. If I showed up at my bank here in Pennsylvania and I had a wheelbarrow full of Canadian dollars and said, I want to deposit this, the bank is not going to say, no, go somewhere else, Jim. We don't want your business. So these are called euro dollars when these are dollar denominated deposit placed in banks outside the United States, but they're called euro currencies when you have just kind of the opposite. Commercial paper, this is short-term debt issued by super large companies like Johnson & Johnson and McDonald's and Procter & Gamble. And remember that, large corporations, they have cash flows that go like this. So in our case, financial institutions, we have cash flows that go like this, right? And this is short-term. So remember, we're trying to manage our short-term liquidity here. So look at in the bold over on the right, manage working capital or to raise working capital. Maturities usually range from, just a couple of days to 9 months. Lots of commercial paper is 270 days because if you issue commercial paper for 270 days, at least here in the United States, then you don't have to go through some extra disclosures and submissions and requirements and regulatory procedures. All right, so if it's called industrial paper, that's used to purchase inventories, but we're probably most importantly interested in finance paper used by finance companies and finance holding companies. Of course, they're sold at a discount. There is no stated interest, so you'll buy this for $99,000 today and sell it for $100,000 weeks from now. I'm guessing that there's some commercial paper out there that's secured, but I've really never run across it, so it's totally unsecured. And by the way, Moody's and Standard & Poor's and Fitch, they rate this commercial paper as well. So there is risk associated with commercial paper, and so the risk associated with our financial institution, if we issue commercial paper to manage our working capital, to manage our liquidity needs, probably has a lot to do with the size of our financial institution. If it's giant Gibraltar financial institution, they probably will get a AAA rating. If it's Jim's little old bank on the corner, who knows what my rating would be. How about long-term non-deposit fund sources? So here's where we creep down into the longer portion. Now remember, some of those shorter terms can be extended to, more than 1 year. We even said there was one in there that could be greater than 20 years. But now we're getting into, what did I say on that very first slide? We're thinking about issuing debt and equity. Well, here's where we get into that part of the right-hand side of the balance sheet. So we can issue some notes, let's call them capital notes. We can issue debentures, which are unsecured, or we can issue mortgages to pay for our physical infrastructure. The problem then, of course, is that there's going to be a maturity mismatch, and this brings the whole specter of duration matching and asset liability management. All right, let's move on to that available funds gap example. And I think we're going to do some calculation here. So you guys will be happy to use your calculator, although I don't know that we really need a calculator to do the math. So let's go ahead and do, let's do a definition there in the box. So current and projected loans and other investments the bank desires to make, minus current and expected deposit inflows, plus other available funds. So just think about this from the balance sheet perspective, and we're going to examine this not from an account perspective, but from a cash flow perspective. All right, here's a bank. We have new deposit inflows of $400 million, deposit withdrawals of $600 million. Oh boy, so inflows of 400, withdrawals of 600. So we're going to think to ourselves, all right, we got to do something here, right? New loan demand, $500 million. Credit lines, $200 million in cash. All right, so, oh my gosh, we got lots and lots of good stuff happening over on our assets. We're going to sell $520 million in securities. So kind of think about all those securities that we've just recently discussed. $100 million in new securities added to the portfolio. So compute the projected available funds gap. And so notice what we've done up at the top. We put some of those in red, some of those in green to highlight the difference between the outflows and the inflows. And that's what we've done there in the solution at the bottom. So the outflows, the 600 and the 500, the 200 and the 100, right? And then the inflows are the $400 million in new deposits and $520 in issuing securities. So there's our funds gap. We'll call that the available funds gap, $480 million. How about that part of the learning objective that asks us to consider factors here? And I think we had a slide similar to this in one of our more recent recordings. All right, so non-deposit funding sources. All right, relative costs of raising funds from each source. Boy, didn't we do like an absolute cost and then we did a marginal cost in one of our previous examples. Of course, risk, volatility, and dependability. Boy, what does dependability mean? Maybe stability, think about there. Remember we had core deposits and then we had volatile deposits. Length of time, of course, size of the institution, and then regulations. Those make perfect sense. So I'm looking at this and I'm thinking of, all right, I can easily write a question stem there and have answers A, B, there's 5 of them there. So A, B, C, D, E, where each one of these would be the correct answer. So that's 5 question stems, and then you'd have the choice from among these 5, and only one would be the correct answer for 5 different questions. So that should be a pretty easy question. All right, how about that learning objective about calculating the cost of funds? A couple of ways we can do this. Historical average cost approach. And remember our discussions from the past where I've always said things like, it's perfectly fine to use an historical approach. But what you're counting on then is for history to repeat itself as you apply those historical statistics to the future. Now, sometimes it's appropriate, and I think it's more appropriate to do it in the top right and top left-hand side of the balance sheet here than it is some other areas that we've talked about in the past. But sometimes it's clearly not appropriate to look at history. Let's just go back. Suppose you look at history from, here, let me just pick 3 random years. Oh, how about if I pick 2005, 2006, and 2007, and we use that historical data to compute or estimate our overall cost of funds for 2008. Now I'm rounding and saying we're going to do this for a year. Boy, how wrong would we have been? So you always have to be really careful when you look at history to make certain that you're in, a relatively stable period. But that's the beauty of this series of chapters that we're reading, because we can calculate these overall cost of funds. And then we can calculate our overall cost of stressed funds if we have to do that. Now, that's not part of the learning objectives in this chapter, but you see how we manage this liquidity risk. All right, a couple of steps here. Weighted average interest expense. We've done that math before. Break-even cost rate, and then calculate weighted average cost of capital. So let's go ahead and look at an example here. So look down the left-hand column. We just have regular stuff from a financial institution. So total funding on the top right of the balance sheet, $1,100. And there are interest rates associated with each one of those accounts. And then the dollar amount of interest cost, right? If you just multiply those two and you sum them, you get the 2825. We're given non-interest rate cost figures there. Non-interest rates. Then we can get the non-interest costs, and so the total funding costs over on the right-hand side. Now look at the bottom under total funding. So that that row that's given to you here in blue would probably not be given to you on the exam. So you'd have to go ahead and sum those columns. You got to do some multiplication and adding in there. Additional information, shareholders require 15%. We're paying a tax at 35%, shareholders equity 200 million, total earning assets of $1 billion. So let's go ahead and work through those 3 costs that we talked about just according to the learning objectives. So weighted average interest expense. So let me go ahead and just toggle back and forth. So all we're going to do is take that 2825 and divide it by the total funding amount, right? So that gets us 2.57%. Our break-even cost, we've got to go all the way over to the total funding, right? We need the interest plus the non-interest cost. So that total was 46.75, and we're going to divide that by the total earning assets, which was what was that, $1 billion or 1,000 here, since we're dropping many of the zeros. So that's how about if I just round 4.7% for our break-even costs. Now we can compute our weighted average cost of capital. So we take that 4.7 or 4.675 and then multiply it by, let me go back here. Let's do it this way. What we want to do is multiply it by the ratio of that 200 million in stockholders' equity, right, divided by the billion or the 1,000 in total earning assets. And then we need to adjust that from our shareholders' perspective. So 15% is the shareholders' required return, and divide that by 1 minus the tax rate, and that gets us a weighted average cost of capital of 9.29%. Now, of course, there are times when the historical approach is not fully appropriate. Then we move to the pooled funds approach, and this just looks forward, right? So what we say is, let's look at our goals. So that we have a minimum rate of return that we know we must earn on future loans and securities that cover all of the costs of these of the new funds that are raised. think of that minimum rate of return. Think of that as, maybe a hurdle rate. And so we're going to break these down into some different categories. So let's go ahead and look at an example. Let's suppose we have a funding package, new loans, $500 million. We're going to raise $550 million to facilitate an investment portfolio of $500 million. So 91% will actually be available to acquire the earnings assets, which means 9% will not, right? All right, so 450 is 4%, plus add another 1% there for non-interest costs. 100 million will be non-interest bearing transaction deposits, and so add some 2% there. So we'll do the same thing that we just did before, but we've got to couch this in just a little bit of a different framework. We'll call this pooled funds marginal cost. So let's remember the stuff that we learned from a previous recording about marginal cost. And then there's a question about the hurdle rate. All right, so there we go down the left-hand column. There are our time and transaction deposits. They sum to 550, and there are the interest rates that are given to us in that previous slide. So total interest expenses are 18, total non-interest expenses are 6.5. So if I sum those, what do I get? That's 24.5. So the pooled funds marginal cost, now this is projected, of course, is the 18 and the 6.5 divided by the total funds available, which was 550, so that gets us 4.45%. To get the hurdle rate, we're going to take that same numerator, the 24.5, but we're going to divide it by the dollars available to place in the earnings asset. So that hurdle rate is 4.9%. And that takes us through our 4 learning objectives. As I look at these 4, I don't know that I can decide if there's one that's most important. But I'm like a lot of you people out there, is that I will tend to focus on those learning objectives in which I have to do some math. But I'm guessing that those 4 learning objectives have great potential for some excellent questions on the exam. So I would know all 4 of those, 25%.